Hi guys, it's Stock Curry, and I'm going to give you everything that you need to know before the markets open on Monday. We're going to talk about the inflation data that's coming out this week. We're going to talk about a possible ban on short selling. So let's get into it. On Thursday last week, shares of regional banks sold off sharply over fears of more bank collapses, specifically around PacWest, after they said that they were looking for a buyer and might be in trouble, and fears started coming up of who was going to be next. But then the bank stocks rebounded sharply on Friday, even though they still ended up with losses for the week. Now, what's interesting about all of this is that the rebound on Friday actually had nothing to do with people feeling like banks were suddenly secure and might not actually collapse. There was something else entirely that caused the massive buying in banks on Friday. And that was the fact that JP Morgan came out and said that US regulators might ban short selling amid the banking crisis. That was in response to the SEC saying that they were going to investigate short selling of banks. Now, what's really interesting about this is that it's caused a lot of confusion. There's a lot of people who are gung-ho about stocks like AMC and other heavily shorted stocks that think that all short selling might be banned, and this is going to cause a massive short squeeze and stocks are going to go to the moon. And I can understand that thought, but it's wrong. We have to kind of look at what happened back in 2008. And back in 2008, when short selling was banned, stocks didn't suddenly moon. All that did was stop new short selling. And as anybody who has been invested in stocks like AMC or any other heavily shorted stocks knows, just because you ban short selling doesn't mean that short selling stops. I know. I actually worked for Merrill Lynch in 2008. I worked in the securities lending, that is the short selling division of Merrill Lynch, during the time when short selling was banned. And I can tell you, short selling continued. It may not have continued in US stocks, but man, we went heavy in the international stocks. Plus, there's a lot of other ways you can get around it with failures to deliver and all kinds of other things. Point is, even if the SEC bans short selling for a short period of time, this is not going to cause a massive rally in stocks. Further, what is most likely is not a full-on ban of all short selling across the market like we saw in 2008. Rather, what is most likely is that they're just going to ban short selling of banks, because the SEC thinks that if you can stop the short selling on banks, this in turn would help boost everybody's belief that the banking sector is fine and banks aren't going to collapse. Now, the big problem with this is the fact that short selling of banks has nothing to do with the reason why banks collapsed. This was just short sellers jumping on the bandwagon and trying to profit off of the fact that banks were collapsing. The fact is, the reason banks collapsed is because of bank runs. And those bank runs weren't caused by short sellers, they were caused by fear and panic in the Main Street market. So to ban short selling on banks, you're not really stopping the bleeding. All you're doing is slowing it down. It would be the equivalent of somebody bleeding out and about to die, and you slap a little Band-Aid on him. It doesn't do anything. It might slow things down for a few minutes, but it doesn't actually stop the bleeding. And that's the problem that we have with the banks right now. We have banks, regional banks especially, that are in big trouble. A lot of them have lost a ton of money on their bond portfolios. And then on top of that, we have the entire commercial real estate crisis that's right around the corner. And in fact, it's happening right now. It may be one of the things that contributed to PacWest now trying to find a buyer because they're struggling to stay afloat. So far, PacWest is still in business. They did not get taken over by the FDIC this weekend, but they might in a week. We'll see. Point is, things in the banking sector are not okay, and stopping short selling is not going to fix it. It's just going to slow things down. Now, that's kind of what's going on in the banking sector, why banks rose significantly on Friday. It was a lot of short covering. That's really what caused the price to go up. But there's other issues in the economy as well, besides just the banking sector. Janet Yellen continues to warn of an impeding debt ceiling limit being hit and warns of an economic chaos unless Congress raises the debt ceiling. Janet Yellen reiterated that the Treasury Department may run out of measures to pay its debt obligations by June. Now, what's interesting about this is Janet Yellen is now saying that the U.S. might run out of money by June. Previously, she was saying the U.S. would run out of money in the first week of June. Now, when I went and looked at how fast the U.S. is spending money, and I looked at when the U.S. might run out of money, I found it could be as soon as May 23rd. May 23rd, which is faster than the rate that Janet Yellen is currently warning about. And this has to do with the fact that the government just has not brought in as much income taxes as they thought they would. People didn't make as much money as the government thought they would because inflation, hello. And now the government is panicking, going, oh no, we don't have enough money to pay our bills, and we're going to run out of money a lot sooner than we thought. Of course, it's not just the government that's running into this problem. Of course, that alone could cause the stock market to go down, but more so, consumers are running into the same problem. Consumers have been racking up credit card debt, trying to just survive with the cost of food and other prices going up. But what's interesting is, even though a lot of people think a recession might come by the end of the year, they're expecting the labor market to start to decrease and for unemployment to increase. But funny enough, we just got the March job numbers on Friday, and they don't show that at all. Sorry, not the March job numbers. The April job numbers showed that job growth totals were 253,000 in April, far beating analyst expectations for 180,000 jobs added. And most amazingly, the unemployment rate fell to 3.4%. Now, Jerome Powell is trying to get the unemployment rate up. He wants it to increase, not go down, because as more people get jobs, this causes more money to enter the economy, which in turn increases inflation. And if Jerome Powell's not able to get the labor market to cool down, and if unemployment keeps going down instead of up, Jerome Powell only has one thing he can do, and that is to keep increasing rates. So much for a Fed pause. The bond markets woke up to this reality on Friday as Treasury yields surged after the much hotter than expected April jobs report. Even futures traders are waking up to the reality that the Fed might raise rates again in June, as prior to the jobs report, 96% of future traders were expecting the Fed to pause. But after the jobs report, that number fell to 89%, with now 11% of futures traders expecting another 25 basis point rate increase. And the fear is, as the Fed continues to raise rates, this could lead us straight into a recession. Of course, it's important to understand that still 89% of futures traders believe the Fed will pause at their June meeting, but that number is decreasing. And the hotter than expected jobs report certainly lends a lot of credence to the Fed continuing to raise interest rates. Of course, other things go into this as well, and that's inflation. Is inflation coming down? Well, we're going to get the answer later this week. As we look at this week's major U.S. economic news and the Fed speakers, keep in mind that last week the Fed speakers were under a blackout period. They were not allowed to speak, but this week they are. So we're going to get a lot more information and details starting on Monday with Chicago Fed President Goolsbee. Then on Tuesday, we have Fed Governor Philip Jefferson and New York Fed President Williams. Then on Wednesday, ding, 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 it is the fully expected CPI, the Consumer Price Index, or this really important inflation report that we want to see. And what I really want you to look at are the numbers here on the right. That was the previous month-over-month CPI was an increase of 0.1%. Previous month-over-month core CPI was an increase of 0.4%. Year-over-year was 5%, and core year-over-year was 5.6%. Keep in mind that the Federal Reserve wants this down to 2%. So long as inflation remains stubbornly high and the labor market remains stubbornly strong, the Federal Reserve is going to be very likely to continue to raise interest rates. Not only are they very unlikely to lower rates by the end of the year, they're becoming less and less likely to even pause. And it's not just the CPI data we're getting this week. We have more inflation data coming out on Thursday. On Thursday, the PPI, or Producer Price Index, comes out. And very often, producer prices show up in consumer prices a few months down the line. So PPI is a really good thing to look at to kind of figure out where CPI might be in the future. Also, at 10:15 a.m. Eastern Time, we have Fed Governor Christopher Waller speaking. We wrap things up on Friday with some minor economic data, and also St. Louis Fed President Bullard and Fed Governor Jefferson speaking. So we'll get more information this week as far as how likely it is that the Fed might continue to raise interest rates instead of pausing, like most people think they were at this time. And just keep in mind that if the Fed does continue to raise interest rates, we are likely to enter a recession by the end of the year. It's important to remember that both experts and consumers are expecting a recession this year. Now, despite the bond market pricing in a recession, and despite the Federal Reserve expecting a recession, and despite economists expecting a recession, and despite CFOs expecting a recession, the stock market is rallying like everything is just fine and dandy in the economy. CNN's Fear and Greed Index puts the rating at 59, which is well into the greed category. The VIX also closed below 18.5 on Friday, which is another indicator of more bullishness in the stock market. So despite the fundamentals of the economy looking absolutely dire, the fact is the stock market remains extremely strong and bullish. Now, it's not because earnings have been particularly great. In fact, earnings have been pretty bad. Yes, a few tech companies beat expectations on already extremely low earnings expectations. And yes, a few mega cap tech stocks rallied after beating those expectations. But most of the stocks that have reported have missed earnings expectations. They've come in lower than expected. And this week, we actually have 30 S&P 500 companies reporting earnings. So it's going to be another jam-packed week full of earnings. All of the mega cap tech stocks have already reported. So now as we get into more healthcare and retail stocks reporting, this is going to have a little bit more of effect on the Dow and the S&P. And we might see a little bit of selling pressure on those indices this week, even if the NASDAQ, which is very tech heavy, continues to rise. Question is, since the stocks are rising, but the earnings are not, and we now have multiples, that is PE ratios, at sky high, near record highs. Just take a look at Apple, for example. Apple stock is near an all-time high, yet earnings are some of the lowest they've been in over a year. And the PE ratio on Apple is now approaching 30. Apple almost never trades at 30 PE ratio. In fact, it almost always sells off once the PE hits 30. Apple really likes to trade at a PE of around 22 to 25. So 30 is getting very expensive on Apple stock. And a lot of the other mega cap stocks are also very expensive in the same manner. Amazon's PE ratio was around 260 as of Friday's close. NVIDIA's PE ratio running up around 150. And by and large, the mega cap tech stocks are very expensive, fundamentally. But again, with market psychology being greedy, these stocks can continue to rally. Just because they're overbought doesn't mean they're going to sell off this week. It usually means they'll sell off eventually, but not necessarily this week. So just keep in mind that if you're buying a lot of the mega cap tech stocks right now, especially the ones that are very expensive, like Amazon, NVIDIA, and Apple, you're buying in what's known as FOMO, or fear of missing out. You've seen these stocks run up. You're now fearful that if you don't buy right now, you're going to miss out on further gains. And in reality, you're most likely buying at the top. In reality, most likely, those stocks are going to sell off. And just to make you aware of some of the biggest stocks reporting this week, on Monday after the close, we got PayPal, Palantir, and Lucid. And then Tuesday before the open, we've got Fisker and Nikola, as well as Novavax and DigitalOcean. Then Tuesday after the close, we've got Airbnb, Rivian, Oxy, and Twilio, as well as Affirm and Upstart if you're still in those. Wednesday before the open is Roblox. And then Wednesday after the close, we've got Disney and The Trade Desk. And then Thursday before the open, JD.com, Fiverr, and then a few other minor companies also. But those are the biggest ones that are reporting this week. Like I said, 30 S&P 500 companies altogether. And just a quick update on myself personally, if you've been following this channel for any length of time, you've probably noticed that I've been a little bit missing the past 2 weeks. My entire family has been sick for the past 2 weeks. We've been dealing with some sort of flu or something that we're still dealing with. We're definitely not over it. But last week I lost my voice, couldn't make any videos. This week I'm back, so we'll get back into our normal daily updates for you guys. So don't miss anything. If you enjoy this video and got a lot out of it, make sure you hit the like button and subscribe and share this video with your friends and family so that they will know what's going on in the market as well. And I hope you guys have a lot of success trading. If you missed the last video I uploaded, it was going over some buys that I recently made. Make sure you go watch the last video here.